Hello and welcome to lesson number 5 and video number 1, in which I will discuss gold's technical setup. Gold is at a very important juncture in its history. It has formed a bullish cup and handle pattern and now a 12-year-long base. Cup and handle patterns are among technical analysis's most reliable bullish patterns. Furthermore, multi-decade long bases tend to give way to multi-year and multi-decade rises. The setup is in place for a very exciting gold market over the years and decades ahead. In past lessons, I explained the importance of intermarket analysis for gold and the entire precious metals sector. Gold must outperform the stock market and other asset classes to be in a secular bull market. In recent years, gold has trended higher but not outperformed the stock market, and as a result, the precious metal sector, the mining stocks and silver especially, has remained in a secular bear market. As you can see in figure 5.1, while gold has formed a cup and handle pattern from 2011 to the present, it has yet to confirm a new uptrend when measured against the S&P 500 and the total return of a conventional 60-40 portfolio, 60% in stocks, 40% in bonds. The blue arrows show resistance at the 80-month moving average. When those ratios move beyond the moving averages, gold will have begun a new secular bull market and be in a prime position to reap the rewards from its super bullish technical setup. Moving on, I want to cover the history and importance of cup and handle patterns in this lesson. A cup and handle pattern is a bullish continuation pattern. That means it develops following an uptrend. The pattern begins as a market declines in the shape of a U more so than a V. When the market rebounds and reaches its previous peak, the cup is complete. The handle is a small correction that retraces no more than 50% of the rebound, usually around 38%. In terms of time, the handle is brief compared to the time for the cup to develop. The upside targets are triggered when the market breaks out of the pattern into a new high. Measuring the depth of the cup and adding it to the previous high gives the arithmetic target. The rarely mentioned log target is achieved by measuring the percentage move from the bottom of the cup to the previous high, and then measuring it forward from the previous high. Technical patterns sometimes fail, but cup and handle patterns are among the most reliable. When the pattern develops as stated and the market trades close to the high during the handle consolidation, the odds of a successful breakout are very high. Gold's current cup and handle pattern is 12 years long. Cup and handle patterns typically occur frequently in shorter time frames over a period of months rather than many years. The following examples provide context for gold's current cup and handle pattern. The best comparison to gold today is the stock market from 1937 to 1950. Figure 5.2 plots the S&P 500. The highlighted portion shows the duration of the cup and handle pattern. The cup lasted 9 years, while the handle lasted 4 and retraced less than 50% of the preceding advance. The market reached its arithmetic target in 4 years and its log target 1 year later. Although it took some time for the market to hit the upside targets, 1949 to 1957 was one of the strongest and smoothest periods for the stock market in its entire history. Figure 5.3 plots gold at the turn of the century and highlights its unconventional cup and handle pattern from 1996 to 2005. This pattern is technically a saucer bottom pattern because it is not a bullish continuation pattern. It emerged from a bottom and it didn't continue a prior uptrend. That technicality aside, the pattern formed a super bullish handle consolidation in 2004 to 2005 and then exploded higher. And although gold endured significant corrections in 2006 and 2008, it followed the outcome of a traditional cup and handle pattern by gaining roughly 300% in 6 years. Figure 5.4 plots the Japanese Nikkei index, highlighting its cup and handle pattern from 1961 to 1969. The Nikkei was so strong that it barely formed a handle before busting out in 1969. After 8 years in a somewhat unconventional cup, the Nikkei exploded to the upside over the next 4 years. From 1961 to 1969, the market traded between roughly 1,800 and 1,000. 4 years after the breakout, the market reached 5,200. Figure 5.5 plots Hong Kong, the Hang Seng Index, and highlights 1973 to 1986. The Hang Seng in 1986 broke out from a 13-year-long base and 2 potential cup and handle patterns. The price action from 1981 to 1986 is its own cup and handle pattern, but could also be the handle to the cup that formed from 1973 to 1981. The Hang Seng immediately surpassed its arithmetic target, 2,900, but did not reach its log target from the 1981 to 1986 cup for another 5 years due to the post-1987 crash malaise. However, after the breakout in 1986, the Hang Seng gained roughly 575% over the next 8 years. From 1973 to 1986, the market could not surpass 1,800. After it finally did, it surged to 12,000 over the next 8 years. The U.S. stock market did not form a cup and handle pattern during its secular bear market from 1968 to 1982, but it did form a multi-decade base. You may recall the famous Dow Jones Industrial Average base from 1966 to 1982. The S&P 500 first broke out in late 1980, ahead of the Dow Jones Industrial Average, but it was not until 1982 that the secular bull market began in earnest. In figure 5.6, we plot the S&P 500 and gold dating back to 1929, and we show the similarities between gold at present and the S&P 500 in the early 1980s, before it began its secular bull market. The major similarity is the 1974 to 1982 period in the S&P 500 with 2016 to 2023 for gold. Each market put in a major price low at the start of the period and then trended higher for over 7 years, but at that point had yet to break away from its secular bear market. Although the stock market trended higher from the mid-1970s to the early 1980s, it underperformed hard assets, just as gold has trended higher since the very end of 2015, but has underperformed the stock market since. Our final chart in this lesson, figure 5.7, plots gold and its rate of change over 2-year and 3-year periods. The cup and handle from 2011 to the present is sketched. This cup and handle pattern is stronger than typical because the right side of the cup, having reached roughly $2,050 an ounce, is higher than the left side, the 2011 peak of $1,920 an ounce. Also, the handle, for other than a few weeks, has consolidated above its 38% retracement in the upper 1600s. The measured upside target from the cup and handle pattern is around $3,000 an ounce, while the log target is approximately $4,000 an ounce. The past examples of cup and handle patterns and the nature of breakouts for multi-decade bases give us reason to expect an explosive move higher after gold surpasses resistance around $2,100 an ounce. The rate of change indicator at the bottom of the chart provides examples of significant advances over 2 years and 3 years. The advances were even sharper in the 1970s. A gain of 140% from gold's 2022 low, October 2022, projects to $3,950 an ounce in October 2025. To summarize this lesson, gold remains in a super bullish base and cup and handle pattern that will lead to an explosive upside move once gold begins to outperform the stock market and conventional 60-40 investment portfolio. The inevitable breakout for gold may require another 12 to 18 months to occur, which in terms of time would match the length of the bases in the S&P 500 from 1937 to 1950, 1968 to 1981, and 2000 to 2013, and the base in the Hang Seng in Hong Kong from 1973 to 1986. It's essential to understand that while the breakout from this cup and handle pattern will have super bullish implications for gold in the first few years that follow, it will mark the start of a new secular bull market in gold. Breakouts from these long bases lead to advances that last at least a decade. That concludes lesson number 5, video number 1. Thank you so much for watching. Next up is lesson number 5, video 2, in which I discuss the technical setup for silver.